And so what happened then? What happened then? We realize that capital is necessary to be rechanneled. We forget that it's necessary to be rechanneled into manufacturing. We continue to remember that it is necessary to be channeled into private homes, things of that sort. And so you come to the 1960s. You come to the urban crisis. I understand there's an expert on the urban crisis in this room somewhere, who can attest that the crisis was a crisis not just of cities, but of America generally. It was a crisis in the sense of what is going to happen in our future. And so new ways of thinking were brought about. Those mortgage bonds that I showed you at the beginning of the presentation, by this point had been banned since the 1930s. First, well, the market for them completely failed during the Great Depression, and then for good measure, states and the federal government, states passed laws to ban them, and the Federal Reserve also banned them as well. But by this point, there was such desperation. There was such desperation about how to fix society that those mortgage bonds, now called mortgage-backed securities, were brought back. Were brought back to fix the American city. This is an ad from The Mortgage Banker, which, as you can imagine, is a very compelling reading, from 1969. This is an advertisement for the Associated Mortgage Companies, saying they are ready to provide the mortgages to be resold into these new kinds of financial instruments. A mortgage-backed security, unlike these intermediate companies, is just a collection of many, many mortgages bundled up and resold, as now we all know. And it was brought back, again, in this collaboration between the state and private business. It was brought back in the Housing Act of 1968. And then the very first one, this is the bond prospectus for the very first mortgage-backed security from 1970. Government, Ginnie Mae and Fannie Mae, now privatized, are part and parcel of this new system, bringing about securitization that ushers in the stage that comes after the post-war. In this moment, instead of focusing on how to provide capital to be invested in cities for businesses, to promote jobs and wages, it's much easier for policymakers to focus on the flip side of that, providing credit for mortgages. Now, within a couple of years, the program in the cities collapses, and yet the mortgage-backed security remains. But now, the coffers for that fat man and that skinny man become limitless, because capital raised on these markets can be given to consumers. And very quickly, within a matter of 10 or 15 years, these securitizations transform. They transform. And so that any form of consumer debt can be resold on the international market. Bypassing traditional bank deposits allowed money to come from anywhere. Small town banks, union pensions. In fact, the very first buyers of this mortgage were 3 public sector unions from New Jersey. Lending on houses, and then for all forms of consumer debt, became easier than ever before. The scale was tipped from business debt to consumer debt. Small banks without sophisticated staffs found that they could make better returns and better risks by investing in these kinds of things, even if they were in the so-called inner city, than on anything else. And so while we talk so much about government spending crowding out business debt, we talk very little about how consumer debt did the same in the institutions on the portfolios that make our economy actually go.